case we have never met, I'm Michael Price, and I want to help you succeed in growing your business.
Welcome. I'm Nancy, your co-host.
And I'm Michael Price, your host.
Welcome back to the Deep Dive. It is February 27th, 2026, and I really want you to take a second and just look at the calendar. Because if you are a veteran, or if you are married to one, or honestly, if you just care about the mechanics of building wealth in this country, the world fundamentally shifted when we rang in the new year.
It really did. I mean, the landscape is completely different than it was even 6 months ago.
We have new numbers, we have updated limits, and we have a strategy that I am just going to say it. Most people are getting dead wrong right now.
Oh, absolutely.
I was scrolling through the source material on some forums last night, and the amount of misinformation out there regarding these 2026 updates is actually kind of terrifying.
It is concerning. You know, the VA loan is arguably the most powerful financial product in the United States federal ecosystem.
Right.
But it is also, without a doubt, the most misunderstood.
Right.
People think they know the rules, but they are playing by the 2020 rule book, or even the 2024 rule book. And in 2026, that is going to actively cost you money.
And we aren't talking about buying a starter home today. We aren't talking about the white picket fence and the golden retriever. The mission for this deep dive into the source material is the 2026 multi-unit playbook.
Yes.
We are talking about using your service benefit to build an actual real estate portfolio, an empire, if you want to be dramatic about it.
And that distinction is vital. This isn't just about housing. You know, this is about leverage.
Exactly. So, here is the roadmap for what we are getting into today. We are going to break down the new 2026 loan limits, the actual hard numbers that dropped on January 1st. But more importantly, we are going to debunk the one-and-done myth, which I still hear every single day.
Oh, yeah, the whole I use my loan so I can't use it again thing.
Right. We are going to completely smash that myth into pieces. Then we are going to get into the weeds, and I mean deep into the weeds, on the specific math of buying multi-unit properties, duplexes, triplexes, fourplexes.
And we really have to talk about the trap, the tiered limit trap.
That is the one that honestly scares me.
It should. It is the one area where the VA loan actually puts you at a distinct disadvantage compared to a conventional loan.
Mm-hmm.
And if you don't see it coming, it will kill your deal right at the closing table.
Wow. And finally, we are going to explain the 25% rule. It sounds like a penalty, but if you actually understand the math, it is the greatest loophole for wealthy veterans to keep buying property when the government essentially tells them to stop.
It is the back door that stays open when the front door is locked.
I love that. Okay, let's jump right in. It is 2026. What are the numbers? Give us the baseline from the sources.
All right, let's look at the data here. As of January 1st, 2026, the Federal Housing Finance Agency, the FHFA, has set the standard single-family loan limit at exactly $832,750.
$832,750. Okay, let's just pause there. That is a very specific number.
It is.
How does that compare to last year?
Well, it is a 3.2% increase from the 2025 limit, which was roughly $806,500. Now, 3.2% isn't a massive explosion.
Right.
We aren't seeing the double-digit jumps we saw back in the early 20s, but it tracks with inflation and it tracks with the general stabilization of home prices we have seen over the last 12 months.
So it gives buyers a little more breathing room.
A little bit, yeah. It covers the inflation of construction costs, essentially, but that is just the standard limit that applies to most of the country, the Midwest, the South, parts of the interior West.
Okay.
If you are in what the government explicitly calls a high-cost area, the game is entirely different.
We are talking Hawaii, the DMV.
Exactly. Hawaii, Guam, the U.S. Virgin Islands, and the high-density metro areas like D.C., Maryland, Virginia, parts of California, parts of New York. In those zones, the limit for 2026 is $12,049,125.
Over $1.2 million.
That is the ceiling for 100% financing in those high-cost areas.
Okay, so we have these two buckets, the standard bucket at roughly $832K and the big bucket at $1.25 million. But, and I really need you to clarify this because this is where the confusion in the S sources starts. I keep seeing folks saying that there is absolutely no limit on VA loans.
The famous no-limit myth.
They are very confident. They say, the limit is a myth. You can borrow $5 million if you want. But you just gave me a very specific number, $832,750, say. So which is it? Is there a limit or is there no limit? Because those two things are mutually exclusive.
It is a paradox, honestly, but it is explainable. And understanding this distinction is the difference between being a novice and being a pro at this.
Okay, break it down for us.
Here is the rule. If you have full entitlement available, meaning you have no active VA loans, or you sold your previous house and paid off the loan entirely, there is technically no regulatory limit on the amount you can borrow with zero down.
So the people online are right.
Technically, yes. If you walk into a bank and want to buy a $5 million mansion in Beverly Hills and you have your full entitlement, the VA handbook does not say stop. The government does not cap that specific loan at $832,750.
Okay, but I feel like there's a massive but coming here.
There's a massive but. Just because the VA doesn't set a limit doesn't mean the bank won't.
Right. I can't just walk into Chase or Navy Federal with a smile and ask for $5 million just because the VA said it is cool.
Exactly. You have to separate the government guarantee from the lender's risk appetite. The VA guarantee is essentially an insurance policy for the lender.
Right.
It says, hey, if this veteran defaults, we will cover 25% of the loan. On a $5 million loan, the VA is guaranteeing $1.25 million.
It is a huge safety net for the bank.
It is, but the bank still has to determine if you, the actual human being, can realistically pay the monthly mortgage. On a $5 million home, do you know what the monthly payment looks like in 2026?
Oh man, I am terrified to even guess. $30,000.
With taxes, insurance, and current interest rates, you are looking closer to $38,000 or $40,000 a month.
Wow.
And this introduces the concept of residual income, which is the real limit for veterans.
Now, we usually hear about debt-to-income ratios, DTI. Is residual income different than that?
It is vital and it is completely distinct. DTI is a ratio, what percentage of your gross income goes to debt. Banks can fudge that a little bit. They can make exceptions.
Right.
But residual income is hard cash. The VA wants to know after you pay that $40,000 mortgage and your car payment and your student loans and your taxes, how much cash is literally left in your pocket to buy groceries, put gas in the car, and pay the electric bill.
It is basically a quality of life metric.
Precisely. And for a loan of that size, what they call a jumbo VA loan, the residual income requirement is astronomical. The bank isn't going to let you live on ramen noodles in a $5 million mansion.
No, of course not.
They want to see thousands and thousands of dollars of unencumbered cash flow every single month.
So the no-limit rule is actually just a high-income rule.
That is the absolute perfect way to frame it. The limit is your paycheck. If you make $500,000 a year, sure, maybe there is no limit for you. But for the average E6 or O3, the limit is very real because their income creates a ceiling long before the VA regulations ever do.
Okay, so for the first-time buyer, the limit is just a question of affordability. But why does the government even publish the number 832,750 then? If there is no limit, why does that very specific number exist?
That number exists for two reasons. One, it is the basis for what the VA guarantees on the secondary market. It is back-end banking plumbing.
Yeah.
But for you, the listener, that number only becomes a hard cap or a strict variable in your calculator when you try to have multiple VA loans at the exact same time.
Ah, okay. This is the pivot.
This is the pivot. If you are one and done, you can ignore the number. But if you want to build a portfolio, if you want to keep home A and buy home B, suddenly that $832,750 becomes the most important number in your financial life.
Because it defines the size of your bucket.
Exactly. Think of your entitlement as a literal bucket of money. The size of that bucket is determined by the county you are buying in. In a standard county, your bucket holds $832,750. In a high-cost county, it holds $1.25 million.
And every time you buy a house and keep the loan, you put a rock in that bucket.
And you can only put rocks in until the bucket is full. Once it is full, you cannot use the VA loan for zero down anymore.
We are going to get to the actual math of the bucket and what happens when it overflows in just a minute. But before we do, I want to talk about what we are putting in the bucket. Because the strategy for 2026 isn't just buying single-family houses.
No, it's about multi-unit properties.
Right, the multi-unit showdown, VA versus conventional.
Let's set the stage for this. We are talking about buying 2, 3, or 4-unit buildings.
Okay.
The goal here is house hacking. You buy a fourplex, you live in Unit 1. That completely satisfies the VA requirement for it to be your primary residence.
Because you can't buy these as pure investment properties.
Right, you have to live there, but then you rent out Unit 2, Unit 3, and Unit 4.
Ideally, the rent from those 3 units covers your entire mortgage and you live for free.
That is the dream, mortgage-free living. It accelerates your savings rate, it builds massive equity, it is a fantastic strategy, But, and this is where people get seriously hurt, if you try to do this with a VA loan, you run into a structural problem that simply does not exist with conventional loans.
The tiered limit trap.
The tiered limit trap. Let's compare them. If you go to Fannie Mae or Freddie Mac, say conventional lending, and you say, I want to buy a single family home, they have a set loan limit. Let's say it's $800K.
Okay.
But if you say, actually, I want to buy a duplex, Fannie Mae says, oh, okay, a duplex generates income. It is a more valuable asset. We will raise your limit to $1 million.
Okay, that makes total sense.
Right. If you say, I want a fourplex, Fannie Mae says, great, we will raise the limit to $1.5 million. They tier the limit based on the number of units. The more doors, the higher the limit.
Because the asset literally supports more debt with its income.
Correct. Now, enter the Department of Veterans Affairs.
I have a feeling I'm not going to like this part.
The VA does not tier limits.
Wait. Back up. What?
It is the critical distinction from the source material that nobody talks about until it is way too late. Whether you are buying a 500-square-foot studio condo, a townhouse, or a massive 4-unit apartment building with 3 separate revenue streams, the VA applies the exact same single-family loan limit.
So that 832,750 number, that applies to the fourplex too.
It applies to absolutely everything.
Frankly, that sounds completely broken. We just spent 10 minutes talking about how the VA loan is the greatest wealth-building tool out there, and now you are telling me it essentially handicaps you on the most valuable asset class.
Handicap is a strong word, but it is an accurate description of the limit itself. The VA statute simply does not distinguish between property types for the purpose of entitlement calculation. In the eyes of the VA, a fourplex is just a home.
But let's play this out in the real world. I am in Chicago. A decent 4-flat in a good neighborhood is going to cost $1.2 million.
Easily.
But the VA limit for Chicago, which is a standard area, is $832,750. So I have a gap of almost $400,000. If I was using a conventional loan, the tiered limit might cover that entire $1.2 million. But with the VA, I am hitting a hard ceiling. So why would anyone ever use the VA loan for a multi-unit property? It sounds like a terrible deal.
It feels like a bad deal because you are only looking at the ceiling, you have to look at the floor, you have to look at the down payment.
Okay, walk me through the math on that.
Scenario A is the conventional loan. You buy that $1.2 million fourplex. Even if the limit covers it entirely, conventional lenders usually require 20 to 25% down on multi-unit properties. They view them as significantly higher risk.
So 25% of $1.2 million, that is $300,000 in cash.
$300,000. Do you have $300,000 sitting in your checking account right now?
Definitely not.
Most veterans don't. Now, scenario B is the VA loan. You are capped at $832,750. The purchase price is $1.2 million. You have a gap of roughly $367,000.
And I have to cover that entire gap.
No, you have to cover 25% of the gap.
Wait, not the whole gap?
No. This is the absolute magic of the VA guarantee. You only have to collateralize the portion the VA will not cover. So 25% of $367,000 is roughly $91,000.
Okay, hold on. Let me look at those two numbers again. Conventional, I need $300,000 cash. VA, I need $91,000 cash.
Exactly. You are controlling the exact same $1.2 million asset, but you are keeping over $200,000 of your own money in your pocket.
So even though the limit is way worse, the cash to close is exponentially better.
Exponentially better. And that is why the tiered limit trap is really just a psychological trap. It feels like you are getting screwed because the limit is lower, but mathematically you are still getting significantly higher leverage than any civilian investor could ever dream of.
That is a massive reframing. It is not about the limit. It is about the leverage.
Exactly. Don't get addicted to zero down, be addicted to high leverage. Getting into $1 million building for less than 10% down is a total home run, even if it is not zero.
This brings us to the actual mechanics of qualifying for that loan. Because scraping together the down payment is one thing. Getting the bank to actually say yes is another entirely. We touched on residual income, but let's break down the qualification trifecta the sources mentioned: income, credit, and collateral.
The three main pillars.
Let's start with credit, because I had a listener ask previously, if I have an 800 credit score, does my loan limit physically go up? Does the VA trust me with more money?
The short answer is no. Your FICO score does not change the federal statute. The limit is $832,750, whether your score is 580 or 850.
So why does the credit score even matter then?
It matters because of the interest rate.
Mm-hmm.
And the interest rate entirely determines your buying power.
Explain that for us.
Let's say you are buying that Chicago fourplex. If you have a 640 credit score, the lender might give you a rate of 7.5%. If you have 760 score, maybe you get 6.5%.
That 1% different, I mean, on $1 million loan.
It is massive. It is hundreds and hundreds of dollars a month. And remember DTI, debt to income. If your monthly payment is higher simply because your rate is higher, your DTI is higher.
Oh, I see.
You might literally disqualify yourself from the loan amount just because your credit score pushed the monthly payment past the bank's tipping point.
So credit is really the lubricant here. It doesn't change the size of the tank, but it totally changes how far you can drive.
That is a perfect analogy. If you are planning to build this empire in 2026, spending 3 months fixing your credit is the absolute highest ROI activity you can do. It is worth way more than trying to find a cheaper house.
Now, what about collateral, the appraisal part of it?
This is the heartbreaker. This is where so many deals die.
Why is that?
Because the VA appraisal is notoriously strict. They have something called minimum property requirements, or MPRs. The roof has to be in good shape. The paint cannot be peeling if it is lead-based age. The heating absolutely must work.
So you really can't buy a fixer-upper fourplex with this?
Not easily, no. You certainly can't buy a gut rehab. The property has to be immediately habitable. But more importantly than that, it has to appraise for the purchase price.
Meaning, if I agree to pay $1.2 million, the appraiser has to agree it is actually worth $1.2 million.
Yes, and with multi-unit properties, appraisals are incredibly tricky. There aren't always good comps, comparable sales in the area.
Right.
If there haven't been many fourplex sales in that specific neighborhood recently, the appraiser might really struggle to justify the value you offered.
And if the appraiser comes back at, say, $1.1 million,
then you have a major problem. The VA will only base the guarantee on the appraised value, that $100,000 difference. You have to pay that in cash, directly out of pocket, completely on top of your down payment.
that is the appraisal gap.
Yes, and it kills more multi-unit deals than anything else combined. So when you are looking at these properties, you cannot just look at the potential cash flow. You have to look at the comps. You have to think exactly like an appraiser. Is this price justifiable based on what sold down the street last month?
Okay, so we have the limit understood, we have the credit, we have the collateral. Now I want to get to the really fun part, the empire building part, the bonus entitlement.
This is where we actually create wealth.
Let's create a character to make this totally real for you listening. Let's call him Marcus.
Okay, Marcus.
Marcus is an E6. He has been in the Navy for 6 years. He is stationed in San Diego, which is a high-cost area.
A beautiful place, extremely expensive.
Marcus bought a condo in San Diego 3 years ago. He used his VA loan. Let's say he used exactly $500,000 of his entitlement on that condo.
Okay, so look at his bucket. He is in a high-cost county. His bucket size is $1.25 million. He currently has a $500,000 rock sitting in that bucket.
So he has $750,000 of space left in the bucket.
Correct.
Now Marcus gets orders. He is moving to, let's say, Norfolk, Virginia, another big Navy hub.
Right, the DMV area, also a high-cost area.
Marcus decides, I am not selling my San Diego condo. I have a 3% interest rate on it from a few years ago. I am keeping it.
Which is a very smart move by Marcus.
So he becomes a landlord. He rents out the San Diego condo. Now he lands in Norfolk. He needs a place to live. He wants to buy a duplex.
Okay, so can he use his VA loan again?
This is the massive question. The one and done myth says no.
But the reality says yes. This is called bonus entitlement or Tier 2 entitlement. Because he has space left in his bucket, he can freely use that space.
So how does the new lender in Norfolk actually calculate it?
They look at the Norfolk limit. It's a high-cost area, so the limit is $1.25 million. They subtract the entitlement he already used back in San Diego, which was $500,000.
So $1.25 million minus $500K equals $750,000.
And that is his remaining entitlement. Marcus can buy a duplex in Norfolk for up to $750,000 with absolute zero down payment.
Zero down, even though he already has a VA loan open.
Even though he already has an active loan, he is holding 2 VA loans simultaneously with zero down on the second one simply because he stayed within the confines of his bucket.
But wait, I need to complicate Marcus's life a little bit here.
Please do.
Marcus has a mortgage on the San Diego condo. Let's say it is $3,000 a month. He is applying for a new mortgage in Norfolk. Let's say that is $4,000 a month. That is $7,000 of total debt. On an E6 salary, his DTI is going to be completely exploded. He won't qualify.
You are absolutely right. If he just carries both debts raw, he is dead in the water. He needs the rental income from the San Diego condo to essentially wash out that original debt.
And he still lives there. He is in the middle of moving.
This is the logistical gymnastics routine of the VA loan. The lender will allow you to use projected rental income to offset the mortgage, but you have to firmly prove it.
How do you prove it if you literally haven't moved out yet?
You need a signed lease agreement.
Yeah,
Marcus needs to find a tenant for his San Diego condo before he closes on the Norfolk duplex.
that is incredibly stressful.
It is beyond stressful.
Ugh.
You are packing boxes, you are negotiating on the new house, and simultaneously you are acting as a frantic landlord, showing your current apartment to strangers, trying to get a lease signed.
And if he does get the lease?
If he gets the lease, and usually they want a copy of the cleared security deposit check too, the lender will take 75% of that rental income and credit it to his profile.
Why only 75%? Why not 100% of the rent?
It is a vacancy factor. The bank assumes the property might sit empty for a month or two, or he might have unexpected repairs, so they haircut the gross income by 25%.
So if the rent is $3,000, the bank only counts $2,250.
Exactly. If his mortgage is $2,200, the debt is cleanly washed. It totally disappears from his DTI calculation. If his mortgage is $3,000, he still has a $750 loss that counts heavily against his DTI.
This is such a crucial detail. You can't just plan to rent it out. You have to execute the rental. Documentation is absolutely everything here.
If you do not have the lease, you do not have the loan, period.
Okay, let's push Marcus even further. He buys the duplex in Norfolk for $750,000, zero down. He lives there for 3 years. Now he gets orders again.
Poor Marcus. The Navy is really working him hard.
He is going to, let's say, rural Oklahoma.
Okay, a standard limit area.
Standard limit, 830 TL with 750. Now let's look at his bucket. He used $500K in San Diego. He used $750K in Norfolk. That is $1.25 million of entitlement used.
His bucket is full. In fact, his bucket is basically overflowing.
He arrives in Oklahoma. He wants to buy a house for his family. He has absolute zero entitlement available.
He is completely tapped out.
Does the VA say, no, Marcus, you have too many houses, stop buying?
No, the VA never says stop. The VA just says, we can't guarantee this next one for free.
This brings us to the 25% rule for when you are totally maxed out.
This is the scenario that scares people, but it really shouldn't. Marcus wants to buy a house in Oklahoma for $400,000.
Okay, $400,000 price, zero entitlement available.
The gap is the entire purchase price, $400,000.
So he has to put 25% down on that gap.
Correct. 25% of $400,000 is $100,000.
Ouch, that is a big check to write.
It is. But let's look at the alternative. If he went for a conventional loan on an investment property, he'd pay 20 to 25% anyway. If he goes for a conventional primary residence loan, he might get away with 5 or 10%. So at $100,000, the VA loan is actually just acting like a standard conventional loan here.
So it basically loses its superpower.
It loses the zero down superpower, but it keeps the no mortgage insurance superpower, and it keeps the low interest rate superpower, so it is still a fundamentally good loan, but it is no longer a magical loan.
But let's tweak the scenario a bit. What if he wasn't totally tapped out? What if he had just a little bit of entitlement left?
That is where the math gets really fun. Let's go back to an example from the source material. A veteran has $500,000 of entitlement remaining, and they want to buy a property for $600,000.
Okay, purchase price is $600K, bucket space is $500K.
They're short by exactly $100,000.
The gap.
The gap. The veteran has to pay 25% of that gap.
What is 25% of $100,000?
$25,000.
Okay, let me just stare at that for a second. This veteran is buying a $600,000 property, maybe nice triplex, and their actual down payment is only $25,000.
That is roughly 4.1% down.
That is basically an FHA loan, which is usually 3.5%, but without the ridiculously expensive mortgage insurance.
Exactly, and unlike FHA, the VA appraisal and terms are often much better for the buyer in the long run anyway.
So the core lesson here is you don't need full entitlement to get a great deal. You just need some entitlement. Even if you have to cover the gap, the leverage you get is insane.
We call this partial entitlement, and it is the absolute secret weapon for veterans who are on their third or fourth property. They aren't getting zero downs anymore, but they are getting 95 or 96% financing on investment-grade real estate.
That is completely unheard of in the civilian world. If I walk into a commercial bank and ask for 96% financing on a triplex, they will literally laugh me out of the building.
They will probably call security on you.
Right. So we have covered the basic numbers, the tiered trap, the whole Marcus scenario, but I want to revisit something we sort of glossed over in the geography section earlier. We talked about high cost to low cost.
That's the geographic trap.
Let's go back to a hypothetical lieutenant. Let's say she started in Hawaii. She bought a condo for $700,000.
Okay, in Hawaii, the limit is $125 million. So she feels very rich in entitlement. She has $550,000 of space left in her bucket.
She feels totally safe. She thinks, I have $500,000 of zero-down power left for my next stop.
Right, but then she gets orders to, let's say, Leavenworth, Kansas.
Standard area. Limit is $832,750.
So she moves to Kansas. She finds a beautiful house for $500,000. She walks into the local lender's office, super confident. I have $550K of entitlement left.
But she is not in Hawaii anymore.
No, she is physically standing in a county where the federal government says the absolute limit is $832,750. The lender takes the local Kansas limit, the $832K, and subtracts her prior usage, the $700K.
So $832,000 minus $700,000. She only has $132,000 of entitlement left.
Her bucket physically shrank. It basically shrank right around the rock she already had in there.
So she wants a $500,000 loan. She only has $132,000 of coverage. The gap is $368,000.
And she has to put 25% down on that new gap.
That is, doing quick mental math here, that is over $90,000.
It is exactly $92,000.
She walked in thinking zero down. She walked out needing to write a check for $92,000.
That is the entitlement trap in a nutshell. It blindsides people every single PCS season. They assume their entitlement travels with them like a fixed bank account. It does not. Your entitlement is strictly determined by the zip code of the new property you are buying.
So what is the actual strategy there? If you know you are moving from a high-cost to a low-cost area, do you just sell the Hawaii condo?
You might have to. If you don't have $92,000 in cash sitting around, you might be forced to sell the Hawaii property just to restore your entitlement. Or you recognize that long-term wealth building requires sacrifice. Maybe you rent an apartment in Kansas for a year, save up the cash, and keep the Hawaii asset. Because selling a property in Hawaii usually means giving up a literal gold mine of future appreciation.
But the reverse strategy works too, right? Like a golden ticket.
Yes, moving from low cost to high cost is amazing. If you start in Kansas, buy a $300,000 house, and then move to San Diego, your bucket expands massively. You bring a tiny rock into a massive new bucket. You have nearly $1 million of purchasing power just waiting for you.
So if you are active duty and you have any control over your career path, or at least the timing of your real estate purchases, you want to buy in the cheap areas first.
Ideally, yes. Buy cheap, then buy expensive. That perfectly maximizes your zero-down leverage over a career.
This is such a critical insight for you to remember. It is not just about affordability. It is about sequencing.
Financial sequencing. It is everything.
We have covered a massive amount of ground today. But there's one final thing I want to speculate on. It was a tiny, tiny note in the source material, but it really caught my eye. Mixed-use properties.
Ah, yes. The loophole within the loophole.
We spent all this time talking about fourplexes, but the sources briefly mention a 4-unit plus commercial space.
Yes. The VA will actually finance a property that has a commercial component as long as the property is primarily residential in its nature.
What does that actually mean, though, primarily residential?
Usually it comes down to square footage and unit count.
Right.
If you have a building with a barbershop on the ground floor and 3 apartments upstairs, that is 3 residential units versus 1 commercial unit. Residential wins the tiebreaker.
And if the square footage of the apartments is bigger than the barbershop?
Then the VA considers the entire building a residence.
This just blows my mind, because if I went to a standard commercial lender for that exact same building, what would they ask for?
They would want 30% down, a minimum. They would give you a 5-year balloon mortgage, meaning the whole loan is completely due in 5 years. And the interest rate would be 2 or 3 points higher than a residential loan.
And the VA says,
is your home, okay, zero down? If you have the entitlement, 30-year fixed rate, standard residential interest rates.
You could literally buy a business location and your home in one single transaction.
Theoretically, yes. It is the ultimate entrepreneur hack. You live upstairs, you run your business downstairs, and the VA finances the entire shell.
But there has to be a catch here.
The catch is the appraisal. Finding an appraiser who knows how to properly value a mixed-use property on a standard VA form is, well, difficult. And finding a lender who won't completely panic when they see a storefront in the listing pictures is also very difficult.
So it requires a real specialist.
It requires a unicorn team. But if you can pull it off, it is the holy grail of VA investing.
And does the income from the barbershop count for your DTI?
That is the gray area. Generally, no, unless you have a solid 2-year history of managing commercial property. The lender usually won't let you use the barbershop rent to qualify for the initial loan. You have to qualify based on your own income and just the residential rents.
So you have to be able to afford the building without relying on the business at all.
Exactly, which brings us all the way back to the limit. You have to fit that mixed-use building under the $832,750 cap or the high-cost cap to keep it zeroed down.
Which might be really hard for a commercial building in a city.
Very hard. But in a small town, a developing neighborhood, it is entirely possible.
I feel like we could do a whole separate deep dive just on that one topic.
We probably should. There is a lot there.
Okay, let's bring this all home. We have hit the 2026 limits, the $832K and the $1.25 million. We have completely exposed the tiered limit trap, meaning VA limits are flat regardless of units. We have walked through the qualification trifecta of income, credit, and collateral. We have told the saga of Marcus and the Hawaii lieutenant, and we have done the hard math on the 25% rule.
It is a really complete playbook.
If you are listening to this and you are sitting on a VA loan benefit right now, what is the one single thing you want them to do today?
I want them to stop listening to their buddies in the barracks or the break room who say you can't do that. The regulations are public record. The math is completely objective. Do not let someone else's ignorance limit your wealth. Go calculate your bucket.
Calculate your bucket. I really like that.
It is the first step. Know your number.
And remember, the limit isn't a wall. It is just a speed bump. If you have the cash to cover the gap, the VA loan works at almost any price point.
Absolutely does.
Well, this has been a beast of an exploration. The 2026 landscape is wide open for business. The opportunities are definitely there. The real question is, are you going to take them?
Market waits for no one.
Thanks for diving deep with us. Go check your entitlement bucket. We will see you next time.
If you found this video helpful, please consider donating to helpallvets.org. Thank you.